Hi class, I'm back with you and I'm looking at problem SE5, and it's a nice demonstration for you about how the allowance for doubtful accounts works for us and makes us stay stable across what actually happens with writing people off. Okay, so the problem says we use the allowance method to record bad debts, and we use the accounts receivable balance method. So they tell us, this is chapter 9, sorry, SE5. They tell us that accounts receivable is $25,400, okay? And that our allowance for uncollectible accounts is $4,900. The allowance for uncollectible accounts is $4,900. So that means our net accounts receivable. And when we say net accounts receivable, we mean the amount that we think we will actually collect out of our balance. That works out to be $20,500. Okay? Then it says, well, what if we find out that we need to write off Tom Novak, who's never going to pay us $2,200? Okay? Well, I would make an entry. I would debit the allowance account for $2,200, and I would credit accounts receivable for $2,200. See, I'm actually removing his account from our books. Okay? So what that means is that accounts receivable would go down $2,200, and the allowance would go down $2,200. Don't forget, this is a credit. This is a credit balance, and I just debited against it. So I would end up with accounts receivable, $25,400 minus $2,200 would give me $23,200, and I would end up with an allowance. See, I debit against this. I would end up with an allowance of $2,700. Look at that. See, net accounts receivable stays the same. We believed before we found out about Tom that we had net accounts receivable of $20,500. Using our matching accrual method of handling the allowance, sure enough, we still have a net accounts receivable of $20,500 even after we write them off. Okay? All right, moving on to SE6. SE6 will be pretty easy for most of you, and some of you have probably done this in your personal life, and this is going to be no big deal. So I'm just going to do a couple of these for demonstration, and you can finish the other three on your own and check your numbers with the solutions, which I will post after I know that everybody that wants to participate has done their discussion questions. Okay. So sometimes we loan people money out of our company, and they have to pay us interest. And sometimes our notes are for 30, 60, 90 days. We might say it's a 6-month note. If that was the case, I would use a half a year. I wouldn't really count the days, okay? But we are going to actually calculate the interest on these notes. And you will remember from another chapter that I told you that when somebody gives you an interest rate, nearly 100% of the time, they mean that to be an annual rate. So if somebody tells you they're earning 6%, they mean that they're earning 6% on an annual basis. So you need to proportion it if you're not going to have a full year. Okay, so A, $58,940 is our note receivable. Okay, we're owed 6%. Okay, but only for 60 days out of 365. Okay, so $58,940 times 0.06 times 60 divided by 365. Okay, so that would work out to be $581.33. So that's the interest that someone owes you at the end of this 60-day note. They'll have to pay you back the $58,940 plus 60 days worth of interest. Okay? B, it says we're owed $14,280 at 9% for 30 days. Okay? So $14,280 times 0.09 times 30 over 365, or times 30 divided by 365, works out to be 105.63. Okay, then you try it for the remaining problems. I know that you can do it. Okay? Let's do E1A and E2A. E1A and no, let's hop over and do E4A, which will make us contrast the same information for the aging method and the net sales method. Okay, Chapter 9, E4A. Okay, at the beginning of 2014, the balances for accounts receivable in the allowance for uncollectible accounts were $215 and a $15.7 credit. Okay, so I'm going to go ahead and set up the T accounts for both accounts receivable and the allowance. Okay, so at the beginning of 2014, $215 in accounts receivable and $15.7. So in other words, we've got $15.7 in the allowance. During the year, credit sales were $1,006,000. Okay, so that means accounts receivable was debited for $1,006,000 when you add up all the sales that you made, and it says collections were $1,475,000. Okay. In addition, $17.5 in uncollectible accounts was written off. Well, you know what that means. That means that the allowance was debited for $17.5 and accounts receivable was credited for $17.5 to write people off. Okay? So let's do a subtotal and see where we are on the allowance account, because we've got a debit balance going here. Let me get a check figure before I get too far along and make a mathematical error that will completely confuse you when you're trying to work this on your own. Okay, so currently that means we've got an $1,800 debit balance in the allowance going. Okay? And that means we've got $322.5 so far sitting in accounts receivable for a subtotal. Okay, then the problem tells us management estimates. A says use the sales method. Okay? Management estimates the percentage of uncollectible credit sales to be 1.2% of total credit sales. Okay, so A is the sales method, which means I don't care what the balance is in the allowance account. I'm going to base the expense off of 1.2% of credit sales. So 0.012 times the credit sales of $1,006,000. Okay, $1,006,000 times 0.012 is 19,200. So my entry is to debit uncollectible accounts expense 19.2. Doesn't matter what's in the allowance. And I will credit the allowance for uncollectible accounts, 19.2. Okay? Then B says, well, what if? What if we use the aging and management estimates the end of year uncollectible accounts receivable to be 19,350? Okay, so B is the aging method or the accounts receivable balance method. Okay, you might hear it said either way. So in this situation, I'm going to have to use the allowance. So this is for part B. I didn't have to use the allowance for part A. But for part B, I am going to have to find a number that will get my aging to 19,350. Because management thinks 19,350 out of this 322.5 will go bad. So I've got to find a number that will get me to 19,350. Well, we've got an $1,800 debit balance, so the number's got to be $1,800 bigger than 19,350 to make it go to zero and then make it go to a credit of 19,350. So 1,800 plus 19,350 equals $21,150. So my entry is debit uncollectible accounts expense $21,150, credit the allowance for $21,150, and see, $21,150 would get me to 19,350. Now the important thing for you to be able to do on the exam, the quiz at the end of the chapter, is you're going to have a multiple choice question, and it's going to give you a scenario, and it's going to say we use the sales method, or it's going to say we use the aging method, and it's going to, one of the choices, both numbers will be in there. So you've got to make sure that you can calculate it independently and say we would debit uncollectible accounts expense $21,150, whatever is appropriate. If it said the aging method, you're going to have to read the questions carefully to see if it's the sales method or the accounts receivable aging method. These are the most important concepts from this chapter. Notes receivable, you do need to know how to calculate interest, how to figure out when a note is due, etc. But the most important thing is what we call the valuation of accounts receivable. The valuation of accounts receivable is accounts receivable minus the allowance. Net accounts receivable is the valuation that we do before we publish our financial statements. Okay? Okay, thank you.